everyone, this is Sir Fahad again with a video, and this time the video is on books of prime entry accounting video. In the last video I discussed about some formats and the video was quite simple, and that video did not meet the criteria of past papers and some complicated questions. So I thought that there must be another video on that similar topic, books of prime entry. So this is a sequel of that video we have seen previously. So this is part 2. The title is saying theory plus past papers. So we will be discussing about the theory part, and then we will see the type of questions we receive in past papers. The type of questions we receive in past papers are quite different from the questions which we practice in our textbooks. So that's why there is a big gap. Students sometimes it becomes quite confusing for students sometimes in order to solve the past paper questions, as they see that there is a difference between those questions which they are practicing and those questions which are appearing in the Cambridge past papers. So they are very much confused. So in order to reduce the confusion level, in order to reduce the complications and the problems which the students are facing, I am making this video. So starting with the video, now coming down to the second slide. The second slide is saying theory review and question type to be received in paper. As far as theory part is concerned, as far as definition parts is concerned, I will repeat some definitions. We did invoice. Invoice can either be a sales invoice or a purchase invoice. How we would get to know that whether it's a sales invoice or a purchase invoice? We will always think from the perspective of the business. For example, as a business, if I am selling some goods or services to the customer, so it will be a sales invoice, and if I am purchasing something, then it will be a purchase invoice. I need to take care of these things. I have to think from the perspective of the business. In any case, we will not think that the customer, it is purchases for the customer though, so I should write purchase invoice. It should not be the case. In every case, we would see that how the business is being affected. For example, I am making sales, so it is a sales invoice. I would be generating a sales invoice, and as far as purchase is concerned, I would be generating a purchase invoice. So invoices were of two types, purchase and sales invoice. We reviewed this now, and then we have credit note. Credit note is always sent from the seller to the buyer in order to confirm that these goods were returned by you, and I have received these goods from you as returns. For example, my customer has sent me goods worth $300. He said that I do not want these goods, these are faulty, or these were not required, and you have sent to me. So $300, I would mention this amount, the quantity of goods and services received, the quantity of goods received. Then I will write it down in the document. The document name is credit note. So I will write it down every detail in the credit note, and then I will send the credit note to my buyer. This is sent by the seller to the buyer. So please keep this in mind. And the second thing and the third thing was debit note. After credit note, we will see debit note. Debit note is the same, but it is sent by the buyer to the seller. These are all business communications between two businesses, and every time when a business is communicating with another business, then there will be a document form, written form, so that both the businesses should have some sort of written proofs in order if there is anything wrong and if anything goes wrong. So those documents will be used as proofs. So debit note is sent by the customer to the supplier in order to confirm that I have sent these goods, and these were the quantities, these were the amounts, so that the business should know that my customer has sent these goods and I have received this. So these both type of documents are sent by that is the debit note and credit note. These are sent by the seller and the buyer both. So next we have the discounts. How many type of discounts do we have? We have two types of discounts. The first discount is trade discount, and another discount is cash discount. Trade discount is discount when we buy in bulk quantities, when we are purchasing more from our suppliers. So then we ask from the supplier for some sort of discounts. In order to encourage the customer, the supplier will always give trade discount to customers who are buying large quantities. So the customer will give us discount for buying in bulk quantities. So discounts given by the supplier, by the seller to the customer for buying bulk quantities always referred to as trade discount. And as far as trade discount is concerned, trade discount is never ever recorded in books. Trade discount is always recorded in invoices. we will always see questions, the practice questions, the past paper question, it will only be in the invoice. It will not be in any daybook, any journal or anywhere except the invoices. So we can say that trade discount will only be shown in the invoices. Then we have cash discount. As far as cash discount is concerned, cash discount is given by the supplier to the customer in order to encourage the customer to pay earlier to the business. For example, I have agreed to my customer that, for example, if you would pay me within 10 days, then I would give you 5% discount. So my customer, if my customer is paying me within 10 days, and I will allow my customers to take 5% cash discount. Any discount given by the supplier to the customer for prompt payment is called cash discount. How do we know that it is a cash discount or a trade discount? For example, in a T account it is written down discount allowed or discount received. So we will always see this thing that, as I repeated earlier, that trade discount will never ever be recorded in the books. It will only be in the invoices. And whenever we are observing this thing in a T account, so we will always say it is a cash discount. Either it will be given by our supplier to us, or we will be giving this discount to our customer. So these can be the scenarios. So, and as far as discounts are concerned, there are two types of discount: discount received and discount allowed. Discount allowed is discount given by us to our customers, so it is an expense for us. Discount received is discount received by us from our supplier. For all, obviously we would be receiving the discount due to the prompt payment we are making to our supplier. So these type of discounts are there. So which type of questions would be there in the past papers? In the earlier questions, the 90s and 1980s and 1990s, 1980s onwards, you would see these type of questions, and you will have the questions in the next slide. So you can see this, you can refer to this. As you all can see that we have a question, and you all can see that we have a password question. The format is that we have date, we will have date, transaction, the source document, account to be debited, account to be credited, books of prime entry, effect on owner's capital. The first transaction is saying the date is 23rd May 2018. The transaction is bought goods on credit $300. Whenever we are dealing in credit, whenever we are purchasing something in credit, and the thing which is being purchased is goods, so we will always record it in purchase journal or daybook. These both names are interchangeably used for the only one thing, that is purchase daybook. We can either say a purchase daybook or a purchase journal. These both are similar. So we will say that, for example, bought goods on credit. Whenever we would be buying anything, we would receive an invoice. So if we are buying something, then for our business it would be purchases, and if it is purchases, then we will be recording purchase invoice as our source document, because it is saying that from which document you are saying that you have gathered this information that you have purchased goods $300. So we are saying that source document is purchase invoice. Then the account to be debited. Obviously the goods are coming into the business. We don't have any goods account, so we will record it in purchases. We have purchases T account, so we will say purchases account. Account to be credited, we are not paying our supplier on that very date, that is 23rd May. So we will record those purchases, we will record the liability. And as far as liabilities is concerned, liabilities always increases on the credit side, and by default the nature of the liability is credit side. So we will increase the liability, that is supplier will be credited. So we would say that the liability has increased because the supplier account has been credited. The books of prime entry which would be used to record these would be purchases daybook or purchase journal. These both are the same names for this thing. Effect on owner's capital. Whenever we are considering this thing, effect on owner's capital, we would see that whether there is an effect on capital, that is a direct effect on the capital, or whether there is an effect on the profit of the business. So we would consider both of these things. If there is an effect on owner's capital, then we will record it in effect on owner's capital, and if there is an effect on owner's profit, then we would record it in owner's capital too. When we would be doing the financial statement, that is income statement and balance sheet, then I would repeat this thing and we can understand the logic. So here we don't have any effect, so no effect, we will write down this. Then the second entry is sold goods on credit. Sorry, I forgot to write down the amount. Now I'm writing it down, $200. So sold goods on credit, whenever we are selling goods for the business, it is sales. Obviously, if it is sales, then we would write down the source document would be sales invoice. We would have obtained these details from sales invoice. In some possible, I have observed this thing that it is saying rather than source document, it is saying account details obtained from. These both are same things. These both columns are same. Whether it is account details obtained from or whether it is source document, these both are same. So account to be debited in this sold goods on credit. Okay, sold goods on credit, account to be debited. For us, the goods are not coming, but we will be receiving some amount from our debtors, from our customers. We say our customers are trade receivables in accounting language. So we will say trade receivables account will be debited, and the goods are going out of the business. We don't have any particular account for goods, so we would record sales. Sales account would be credited. Books of prime entry, whenever we are making any sales on credit, so we would record it in sales daybook or journal. These both names are being used. Sold goods on credit, whenever we are selling goods on credit, here the profit has not been disclosed, but in your past paper question, the profit would be, it would be more obvious that the cost would be disclosed there. For example, if I am considering this, that I have incurred cost of $100 on these goods and I am selling it in $200, so the profit would be plus $100. So if my profit is increasing, then in effect on owner's capital, I would write plus $100, plus $100, and I am writing it down here. Cost price was $100. So we are assuming this. Okay. So in the third transaction, we are saying goods returned by customer. If our customer is returning the goods, in past paper 2 questions, always write down credit note. There is a reason, because we would be as sellers, we would be providing our customers a credit note. Whenever the document is being asked from the perspective of the business, so we will always, from the document which is sent by the seller to the buyer is credit note. So obviously we would be sending the credit note. So we would write down credit note. Account to be debited would be the sales returns account. Why? Because the goods are coming back into the business, and the account to be credited, or previously we have recorded these trade receivables. So now we will decrease the amount which we would be receiving from our customers, because the customer has returned some goods to us. Books of prime entry, obviously the sales return daybook. Okay, the amount would be goods returned by customer. As you all can see that we were having 100% profit, as the cost was 100 and we were selling it on 200, so we have 100% profit. So goods returned by customer, obviously previously we wrote it down as 100. We increased the amount of profit as 100. So here we are saying that goods returned by customer, and this is list price. I will write down list price $100. List price $100. So the selling price was 200 and the customer has returned the 50% goods. If he has returned the 50% goods and we used to have 100% profit, as you all can see that the goods were worth $100 and we were selling it in 200. This is the selling price as seen 200. The customer returned the goods of 100. So the total profit was 100, and then now the customer has returned 50% of the goods. So we would record minus $50 as a reduction in the profit. Sold a motor vehicle on credit. We don't have any journal for these kind of assets and these things. So we have sold motor vehicle on credit. So we would say source document is always the sales invoice, because we are selling motor vehicle, And account to be debited, sold motor vehicle on credit. So account to be debited will be disposal account. You have not studied depreciation topic. When I would be uploading a video on depreciation, you will be clear about the disposable account, why we are making this disposal account. So credit as motor vehicle, obviously the motor vehicle is going out of the business, then we will credit this account. Okay, so we have this. Okay. Now we would say books of prime entry, general journal. Sorry if I am pronouncing it incorrectly. So general journal. So the profit, effect on profit, sold motor vehicle on credit, no effect on profit, because we are assuming that the cost was also 200 and then we have sold it in 200, so there is no profit, no loss, no gain. The second last transaction is bought furniture paying by cash. Whenever we are buying furniture, we will record it in general journal if we are buying it on credit, but here it is saying bought furniture paying by cash. So whenever we are buying anything, we would record it, we would say that source document is always the purchase invoice which was made on that particular date. Okay, account to be debited, something which is coming into the business is furniture. So the same logic, furniture account. Sorry, the spelling is incorrect. Furniture. Okay, then we have account to be credited, the cash is going out of the business, so we will record cash. And the books of prime entry, is the general journal. Do you think that it is general journal? No, it is not general journal. The reason is that we are paying it in cash, and anything concerned about cash or bank will be recorded in cash book. So please be attentive in this and be vigilant about this fact that whenever we are buying anything in cash or bank, so we need to record it in cash book. So students sometimes often make mistake. They see that furniture is being bought, so they write it down in general journal. It is a common mistake in students, so avoid this mistake and read the question very carefully. So do we have any effect on capital or profit? No, no effect. And the last transaction is saying that goods returned by us $170. This is obviously the purchase returns, so we will say it is credit note. Whenever we would see a question in the examination about returning anything, to be returned by us or returned by the customer, we would always write credit note. So this is the logic, this is a shortcut. So account to be debited, obviously the supplier's account. Now we will have to pay the supplier less amount because we have returned some goods, so the liability is decreasing, that's why we are debiting the supplier account. Account to be credited, obviously the purchase returns account which is to be debited. And the second last column is books of prime entry. In which book of prime entry it would be recorded? Obviously the purchase returns day book. Okay, purchase returns day book. And the last is no effect on capital. Okay, the reason why there is no effect on capital is that we would have bought these goods on cost, and now we are returning those goods, so there was no profit element by us. In the customer scenario, we have mixed some sort of profit in the goods, in the selling price, so that's why we were deducting that profit which we would have recorded in our books. So we were eliminating that profit from our books, so that's why we have an effect of plus 100 here, and then we have an effect of minus 50 here. So this was the reason that we were having an effect on capital. Okay, the similar type of questions are there in past papers. You can try out those questions in the past papers. And as far as some common errors are being considered, so we have purchase daybook. Purchase daybook and purchase journals are both same things. Then we have ledgers, subdivision of ledger and ledger. These both are similar terms. Ledgers are general ledger, purchase ledger and sales ledger. Purchase journal, if we are making purchase journal, then we would go to the purchase invoice, then we will make the purchase journal, then we will come to the purchase ledgers. In the purchase ledgers, we will make the T accounts of every supplier, and then we will record the purchases of every individual supplier in his or her T account. Then in the end, we will post the total of the purchase daybook in the general ledger, and in the general ledger we have the T account of purchases. In the purchase, we will write down on the debit side total for the month, and the total of purchase daybook would be copied down into the purchases T account in the general ledger. Okay, so the same is the case with the sales daybook. First we will record down sales invoice, then we will record sales daybook, then we will record the sales ledger. And the sales ledger we would make the T accounts of the customers, and in every T account we will post the individual transaction of every customer. Then in the end we will write it down, we will make the general ledger. In the general ledger we have a T account of sales itself, then we would write down the total for the month on the credit side, and the total would be copied from the sales daybook. Similar is the case with the purchase returns daybook, sales return daybook, both with the purchase returns daybook and the sales return daybook. In the general journal, we don't make any ledgers after posting it in general journal. So be aware of this fact, that you do not be confused about these terminologies, and remember this thing, that purchase daybook and purchase journal, sales daybook, sales journal, journals and daybooks are similar terms. We can use this term time and again with the same for the same thing. So these both are books of prime entries. Okay, I hope you like the concept and you got the concept. If you like the video and you got the concept, then hit the like button. Comment below if you have any queries, any questions, any problems. Okay, in the end you would see my contact page. If you want to contact me, if you want to ask me, if you have any queries, and you can contact me there. And subscribe to my channel. If you haven't subscribed, press the bell icon. Don't forget to press the bell icon, because if I would be posting any video, then you will get the first notification to watch that video. Stay blessed, stay inspired, and I love you all.
Like a bird on a tree, I'm just sitting